everyone, welcome back. I know it's been quite a while since I've uploaded a video, and I do apologize, but a lot of things got in the way. Anyway, I know I said that from the next video onwards, I would start a series on Donald Trump's return to the White House and the impact of his actions on the global stock markets. But I've decided to go a different route. I feel that I should talk about some basics of the stock market, and hence I've decided to create a series on the different kinds of ratios, what they are, how they work, and how you can use them to your advantage. And kicking off this series is the very famous PE ratio. By the end of this video, you'll know how to calculate the PE ratio, what a PE ratio tells about a company, the difference between trailing versus forward PE ratio, and industry benchmarks, and the do's and don'ts around PE. I hope you guys will enjoy this series and get right into it. Think about Google Maps. You know how you use them to navigate around different places? The PE ratio is similar to Google Maps for stock market and stock valuation. You can plug in the stock price and earnings report, and the ratio will help you determine if a stock is well priced or overpriced. Let's first understand what the PE ratio actually is. PE ratio stands for price to earnings ratio. Its formula is share price divided by earnings per share, or EPS. The EPS is the company's earnings or net income, or the shares outstanding over the past 12 months. Here, I'll give an example so you will understand this concept a bit better. For example, if a stock is trading at $300 or 300 rupees and the EPS is $15 or 15 rupees, then the PE equals 20. Now, when we say that the PE of a stock equals 20, it means that for every 1 rupee or $1 profit, you're paying 20 rupees or $20. This helps us gauge the confidence of the investors for a particular stock. The importance of the ratio is that it provides us with a snapshot of the valuation, that is, whether a stock is cheap or expensive, and also helps us compare similar businesses. Now, the next thing I want to talk about is trailing and forward PE ratios. These are two very useful concepts that will help you further understand PE ratios. The trailing PE uses actual past earnings of up to 12 months. This ratio is backwards looking. This PE uses analysts' forecast for the next 12 months. This ratio is more speculative and forward looking. I'll give you an example for this. Let's consider Apple. Let's say that the current share price of Apple is $180. Actually, it's $207 the last I checked, but anyway, for the purposes of our example, consider it to be $180. We know that the EPS is $6. Therefore, the trailing PE equals 30. Similarly, if analysts predict the EPS to be $8 next year, then the forward PE equals 22.5. It's important to note, however, that when the forward PE is lower than the trailing PE, growth is expected, and if higher, earnings might decrease. The PE ratio is most useful when used within the same industry. For examples, traditionally the tech stocks have had a PE between 25 and 35, while the utility stocks have had a PE between 10 and 15. It's also useful to compare the company to its sector average PE. For example, if Infosys has a PE of 18 while the tech sector average PE is around 25, it can mean two things. Number one, either the company is undervalued, which is usually a good thing for investors, or number two, it could mean that the company is facing certain issues. Here's our first example of FedEx. As of July 2025, FedEx has a PE ratio of around 15. What does this tell us? Historically, the average PE for the transportation sector sits between 14 and 18. FedEx's current PE of 15 suggests it's fairly priced, maybe even slightly undervalued, especially when you consider its strong cash flow and improved margins post COVID. But here's the real kicker: FedEx recently implemented aggressive cost cutting measures and automation investments. If earnings grow faster than expected, today's PE might actually be a bargain. Our next example is Tesla. Tesla's current PE ratio is about 60, which is way above the S&P 500 average of 25. What does this mean? Investors are pricing in massive future growth. They're not just buying Tesla's current profits, they're betting on its future dominance in AI, energy, and robotics. But remember, if Tesla doesn't deliver on those growth expectations, that high PE could backfire. This is where PE can mislead beginners. A high PE doesn't always mean overvalued, but it does mean that expectations are sky high. Now, let's look at some Indian examples. Consider Infosys, one of the India's biggest IT firms, which currently trades at a PE ratio of around 22. How does that compare? The IT sector in India typically averages around 20 to 25. So Infosys is hovering near the median. This reflects steady expectations, consistent growth, strong clients, and decent margins. It's a textbook example of a stock with low volatility and predictable earnings, which makes it easier to compare against competitors using PE. Now, let's talk about a more extreme case: DMart, the Indian retail giant, which trades at a PE ratio of nearly 100. Yes, you heard that right, 100. Why so high? Well, investors are betting on massive long term expansion of DMart stores, network, and supply chain dominance. But profits haven't scaled at the same pace, which makes the valuation speculative. So, while the fundamentals may be strong, the PE ratio reflects a future premium, meaning people are paying now for what they think the company will earn later. So, what's the takeaway from this? Context is everything. The same PE ratio can mean different things depending on the stock and sector. A PE of 15 for FedEx means fairly priced. A PE of 15 for Tesla? Probably crashing. A PE of 100 might be crazy for some sectors, but expected in others like high growth retail or tech. Always look at sector average PEs, the company's earning trend, future guidance, and investor expectations. This is why context matters more than the numbers themselves. Let's talk about valuations. One of the biggest flashing signals in the post COVID US stock market has been the price to earnings ratio, or PE. At its core, PE tells us how much investors are willing to pay for every $1 or 1 rupee of the company's earnings. So, a PE of 25, that means you're willing to pay $25 for each $1 the company earns per year. Historically, the average PE ratio for the S&P 500 has floated between 15 and 18. During the pandemic, the US central bank, called the Federal Reserve, cut its main interest rate to nearly zero. That meant borrowing money became super cheap. At the same time, the government injected a lot of cash into the economy. With low returns on things like savings and bonds, investors started pouring money into stocks instead. This pushed stock prices and overall market valuations way higher than usual. By mid 2021, the S&P 500 PE ratio crossed 37, nearly double its historical average. As of July 2025, it's cooled a bit, hovering around 27, but it's still stretched compared to the long-term norms. But here's the thing: PE ratios can be noisy. One-time events like stimulus fueled profits or temporary cost cuts can distort earnings and make valuations look healthier than they are. That's where the CAPE ratio comes in. But wait a minute, what is CAPE? CAPE stands for cyclically adjusted price to earnings ratio, also called the Shiller PE, named after Nobel Prize winning economist Robert Shiller. Unlike regular PE, which looks at just the last 12 months, CAPE averages earnings over the past 10 years adjusted for inflation. In simple terms, CAPE is like a long term weather report, while PE is just today's temperature. It filters out short term noise and gives us a better sense of whether the market is truly overvalued or undervalued. As of July 2025, the S&P 500 escape ratio is around 31.5. That's nearly double the long-term average of 16 to 17. That means even though earnings have rebounded post-COVID, investors are still paying a steep premium, mostly based on future expectations, not current fundamentals. And what about India? It's not just the US riding high on valuations. Let's bring in the Nifty 50, India's benchmark index. India, as of July 2025, sits at a P ratio of around 24 to 26, while the long term average is closer to 20. Now, let's talk about India's CAPE ratio, which tracks 10-year earnings adjusted for inflation, just like the US version. The Nifty 50 CAPE is currently in the range of 25 to 28, again, signaling elevated valuations. Now, why does this matter? Because even in a growing economy like India's, high valuations imply that a lot of optimism is already priced in. If earnings growth slow or expectations get reset, markets could correct sharply. So, what's the takeaway? High PE ratios tell us investors are optimistic. High CAPE ratios tell us that this optimism has lasted a while and might be overextended. Both the US and Indian markets are showing signs of valuation overheating, especially when you consider potential headwinds like inflation, rising interest rates, and geopolitical uncertainty. Investors aren't just paying for what companies are earning now, they're paying for what they hope they'll earn later. And when hope gets too expensive, corrections tend to follow. Keep that in mind. So, now that we know what the PE ratio is and how to calculate it, let's talk about how it's actually used when making investment calls. Because knowing the number doesn't help unless you know what to do with it. At its core, the PE ratio helps investors decide if a stock is fairly priced. Think of it like this: you're buying a business, not just a name. Would you pay 50 rupees or $50 for a company that makes 1 rupee or $1 in profit every year? That's a PE of 50. Sounds expensive, right? But sometimes a high PE is justified. If a company is growing rapidly, people are willing to pay more now for potential future earnings. Take Tesla, for example, once again. Tesla had a sky high PE ratio, over 1000 in 2020. That sounds crazy until you realize investors were betting on its future dominance in the EV market. It was less about what Tesla was making and more about what it could make. A standalone PE ratio means nothing without context. That's why smart investors compare a company's current PE to its historical averages, the PE of its competitors in the same sector, and the overall market's PE. Here, let's say you're looking at Infosys. The PE ratio is around 27. Now, compare that to TCS, which is around 30. If Infosys is growing at the same pace or faster than TCS, but is trading at a lower PE, it might indicate that it's undervalued. But again, if Infosys is dealing with some internal issues like slowing revenue, or client loss, a lower PE might be totally justified. So, don't just blindly buy the cheaper stock. Let's say you're a value investor, like Warren Buffett. You typically look for lower PE stocks, especially those with strong fundamentals. You'd want good companies at fair price. But if you're a growth investor, you might be okay with paying a higher PE, like in the case of Amazon or Netflix, in their earlier stages. You're not buying today's earnings, you're buying tomorrow's potential. So, the PE ratio becomes kind of like a personality test for your investing style. Are you conservative, aggressive, or somewhere in the middle? Now, here's the honest truth. The PE ratio, it can mislead you. Here's how. It only uses earnings, which can be manipulated using accounting tactics. You can read up on non GAAP earnings if you're curious. It doesn't account for debt. A company might look cheap on only its PE basis, but might be drowning in loans. And it ignores growth. Two companies might have the same PE, but totally different growth trajectories. For example, take ITC Limited, which has traditionally had a low PE ratio because of its exposure to the tobacco industry, despite strong cash flows. Investors price in ethical concerns and regulatory risks, which affect the PE. Meanwhile, a tech startup with zero profits might have a negative PE, which makes the ratio useless until the company becomes profitable. So, here's what you should keep in mind. A high PE isn't always bad. It could mean high growth expectations. A low PE isn't always good. It could mean poor outlook or trouble ahead. So, compare PE within sectors, not across them. Comparing Tata Steel's PE to HDFC Bank's is like comparing a cricket bat to a tennis racket. Different sports, although similar tools. Alright, let's get real. The PE ratio is one of the most used tools in investing, but it's not perfect. Think of it like a selfie filter. It gives you a general idea, but it doesn't always show the full picture. Here's what you need to know. Companies have a way of making their earnings look better than they actually are. It's called earnings management, and while it's often legal, it can distort reality. Here's how. Number one, timing tactics. A company might delay expenses or accelerate revenue recognition just before a quarterly report. Number two, accounting choices. Different depreciation methods and tax accounting can change reported net income. For example, back in 2001, Enron infamously used accounting tricks to boost reported earnings. Its stocks looked cheap on the PE basis until the company collapsed. So, if you're just using the PE ratio without digging into how the earnings were made, you're flying blind. The PE ratio is all about the current or past earnings, but the markets are forward looking. They care all about the future growth. A company with a high PE might still be a good buy if its earnings are expected to grow rapidly. On the flip side, a company with a low PE might not be undervalued. It might just be stuck. For example, take Tesla again in 2021. It had a sky high PE of over 300. At first glance, wildly overpriced, but investors were betting on future dominance in electric vehicles. That's why some investors also look at the PEG ratio, the price to earnings to growth, which adjusts for earnings growth. More on that in another video. Stay tuned. Comparing the PE ratios of a tech company and a utility firm makes no sense. Tech companies often trade at a higher PE ratios because they have high growth potential. Utilities are more stable but slow growing, so low PEs are normal. For example, as of July 2025, Infosys has a PE of around 2022, while NTPC has a PE of around 11. Both are legit companies, but their industries operate on different rules. So, always compare PEs within the same sector. You can find these values on sites like screener.in or Money Control or Yahoo Finance. Two companies with the same PE ratio might look identical, but what if one has 10,000 crore rupees in debt and the other is sitting on 5,000 crore in cash? Big difference, right? The PE ratio doesn't factor in the company's balance sheet. That's why analysts also use the EV to the EBITDA, the enterprise value to earnings before interest, tax, depreciation, and amortization ratio, which accounts for debt and cash. I'll get into this ratio in a later video as well, so stay tuned for that as well. Think of it in this way: PE is like judging someone based only on their income, not knowing if they're drowning in student loans or sitting on an inheritance. Here's a big one. If a company has negative earnings, aka losses, the PE ratio becomes meaningless. It's either listed as not applicable or shows as a negative number, which doesn't help at all. For example, Zomato reported losses in several quarters post IPO. So investors couldn't rely on PE at all to value it. They had to look at other metrics like price to sales or growth in active users. So the bottom line: use it, but don't depend on it alone. The PE ratio is like checking a car's mileage before buying. It gives you a clue, but you still need to look under the hood. Use it as a starting point and then dig deeper. Check for earnings quality, compare with peers in the same industry, and the most important is add context. Look at growth, debt, and management quality. Look, in investing, no single metric is the holy grail, but knowing when and how to use each tool makes all the difference. So, now you know what a price to earnings ratio is, how it works, and how to actually use it instead of just throwing it into a conversation like it's some financial buzzword. We've seen that the PE ratio is super useful, but it's not the be all and end all kind of scenario. Like we said before, context is everything. A high PE could mean a company is overvalued or just that investors expect explosive future growth. A low PE might look like a bargain, but could signal something fundamentally wrong. So, use it smartly, use it comparatively. Always ask yourself, what story is this number telling me? Now, before we wrap, let's get real. The market isn't a math test, it's a psychology experiment. People overreact, narratives dominate, and numbers like the PE, well, they help cut through that noise. But to really level up, you'll want to go beyond the basics. So, what's next? Alpha, beta, and beating the market. In the next video, I'm going to talk about alpha and beta, two metrics that sound like frat brothers but are actually key to understanding how a stock performs relative to the market. So, if you've ever wondered how to tell if a stock is truly beating the market or if you're just taking on more risk for nothing, alpha and beta are your cheat codes. This next episode will break them down with real life examples, side by side comparisons, and more. So, make sure you hit subscribe, drop a comment, and if you've got any questions or want me to cover something specific. And yeah, thanks for watching. Till next time, invest smart and stay curious.